Inflation is more than just rising prices. It is an abstract economic concept that subtly, yet profoundly, reshapes the financial landscape for individuals and nations alike. Its pervasive influence often goes unnoticed by the casual observer. The effects of inflation are rarely, if ever, evenly distributed across society. Instead, it creates a dynamic where wealth often flows in a specific, discernible direction, favoring some while disadvantaging others. This mechanism is crucial to understand. This documentary will explore the intricate mechanisms behind inflation. We will uncover its hidden costs and analyze the long-term implications of persistently rising prices, particularly how they contribute to wealth disparity. At its core, inflation fundamentally represents a decrease in the purchasing power of money. What $1 could buy yesterday, it cannot fully buy today. This erosion is a silent thief of value. This phenomenon primarily occurs when the supply of money in an economy increases faster than the commensurate production of goods and services. More money chasing the same amount of goods inevitably drives prices higher. The direct result is that each unit of currency, whether a dollar, euro, or yen, buys less than it did before. The tangible value of cash holdings diminishes over time, impacting everyone who holds currency. When new money enters the economic system, its initial recipients are often those closest to the source of its creation. This typically includes central banks, commercial banks, and large financial institutions. They are the first to access this fresh capital. These entities then proceed to lend this newly created money out, injecting it into various sectors of the economy. This process fuels economic activity, ostensibly stimulating growth and investment. Critically, those who receive this money first can deploy it into assets or investments before the full effects of inflation ripple through the broader economy. They benefit from asset price appreciation before consumer prices widely adjust, creating a significant and often unseen advantage. The effects of inflation do not hit everyone simultaneously or uniformly. There is a distinct lag in how price increases manifest across different sectors and income groups. This creates an uneven playing field. Prices rise gradually and sequentially, not in a single instantaneous surge. This creates a temporal gap between the initial injection of new money into the system and the subsequent, widespread increase in consumer prices for everyday goods and services. This lag period is precisely what allows some economic actors to profit at the expense of others. Those positioned to receive and spend new money early can acquire assets at pre-inflated prices, effectively transferring wealth from those who receive it later. Inflation frequently manifests itself first, and most strongly, in the realm of asset prices. This includes significant sectors such as real estate, the stock market, and other investment vehicles. These assets often become inflation's early indicators. Those individuals and institutions who already own these assets see their values increase, often dramatically, during inflationary periods. Their existing wealth grows on paper, offering a buffer against rising costs elsewhere. This mechanism is a potent force in widening the wealth gap. As asset values soar, those who possess significant portfolios grow wealthier, while those without substantial assets are left to contend with the rising cost of living, effectively driving an upward transfer of wealth. As consumer prices continue their upward climb, workers inevitably demand higher wages. This is a natural response, as they strive to maintain their accustomed standard of living against the backdrop of eroding purchasing power. This demand for higher wages can, in turn, lead to a phenomenon known as the wage price spiral. Businesses, facing increased labor costs, often pass these expenses on to consumers through even higher prices for their goods and services. Such a cycle can become self-perpetuating, where rising wages fuel inflation, which then demands further wage increases. Ultimately, this spiral often fails to keep pace with the true cost of living, leading to an overall erosion of purchasing power for many. One of the most insidious effects of inflation is its significant erosion of the value of savings. Money held in bank accounts or low-yield instruments steadily loses its buying power over time, often unnoticed by the account holder. This impact disproportionately affects individuals on fixed incomes, such as retirees, and those with limited investment options. Their accumulated wealth, intended for security, dwindles in real terms year after year. It profoundly impacts the less financially secure, making it exceedingly difficult for them to build wealth or achieve long-term financial stability. Their modest savings are stealthily devalued, hindering economic mobility. Inflation can, for a time, create a deceptive illusion of prosperity. Individuals may feel wealthier as the nominal value of their assets, such as homes or stock portfolios, rises significantly on paper. However, this perceived wealth often encourages increased borrowing and unsustainable spending habits. People may take on more debt, convinced they are richer, only to find their real purchasing power has not kept pace. This ultimately exacerbates the problem, leading to potential financial instability for individuals and the broader economy. It represents a dangerous trade-off, where temporary feelings of affluence mask underlying economic erosion. Governments often find themselves in a peculiar position with inflation. It can, paradoxically, be beneficial for them in one specific aspect. It reduces the real value of their outstanding national debt. When prices and wages rise, tax revenues typically increase in nominal terms, while the fixed nominal value of past debt shrinks relative to the economy's size. This effectively lessens the burden of repayment. This dynamic can inadvertently incentivize policies that contribute to inflationary pressures. Governments might be less inclined to curb inflation if it provides a convenient, albeit hidden, way to manage their fiscal obligations. Such policies further contribute to the ongoing transfer of wealth, often from taxpayers and savers to the state. Inflation is not a phenomenon confined to the artificial boundaries of national borders. It is intrinsically a global economic force, with international implications and interconnected patterns. Global trade flows, supply chain dynamics, and currency exchange rates play a significant and complex role in how inflation manifests and impacts different national economies. What happens in one major economy can ripple across the world. Therefore, understanding inflation requires a global perspective, acknowledging the intricate dance between domestic policies and international economic realities. The cumulative, long-term consequences of persistent inflation, particularly when it leads to significant wealth transfers, are dire. They include a marked increase in economic inequality, exacerbating societal divisions. Such disparities often sow the seeds of social unrest, as large segments of the population feel economically disenfranchised and exploited. Trust in institutions can erode significantly. Ultimately, unchecked inflation and its attendant wealth redistribution can lead to widespread economic instability. This threatens the foundational structures of a stable and prosperous society, demanding careful and deliberate policy responses.